Something devastating is happening in the housing market. Everybody for some reason believes that if the Fed is going to lower interest rates, then home mortgages will immediately get cheaper. Unfortunately, that comforting idea is completely wrong, and it's silently killing your wallet. So even if the Fed lowers interest rates, mortgage rates are not coming down for the reason that I will explain here in this video. And if you do nothing to change that, this could potentially hike your mortgage rates to levels that we haven't seen since the 1970s and 1980s. So if you're ready, give this video a thumbs up and let's find out when mortgage rates will finally come down. Let me pull back the curtain. Most people picture a cozy scene. You walk into a bank, sign a few papers, and the bank kindly lends you money that it first borrowed from the Fed at a cheaper rate. End of story. That picture is comforting, yes, but it's also completely false. The truth is harsher, and it is tightening around us like a vice right now. Banks fund the vast majority of mortgages with cash they raise from investors, not with cheap money from Washington. For every dollar a bank receives from the Fed, it borrows about $50 from pension funds, insurance giants, hedge funds, and overseas institutions. The Fed is just a tiny safety valve, not a bottomless gift bag. That means mortgage rates depend on what global investors demand, not on the policy meetings you watch on the evening news. Here is where the plot thickens. 30-year mortgages scare investors. Imagine locking your savings away for a generation while wars, pandemics, and political tempests rage. Nobody wants that risk unless the reward is juicy. So banks bundle mountains of mortgages into bonds called mortgage-backed securities, or MBS, and sell them off, claiming, "Relax, Uncle Sam stands behind these bonds." Without that federal guarantee, most buyers would run. In 2008, the Fed stepped into this fragile market and started buying trillions of dollars of MBS to stop a collapse. Each purchase pushed yields down and dragged mortgage rates lower. Fast forward to the COVID shock, the Fed slammed the buy button again, stuffing even more MBS onto its balance sheet. Rates sank to unheard of lows, and sellers celebrated. But those celebrations hit a time bomb, because one day, the Fed would have to unload that mountain of bonds. That day arrived in 2022. The Fed announced a plan to shrink its balance sheet by roughly $35 billion in MBS every single month. Overnight, the biggest buyer in history became a relentless seller. Supply ballooned, demand balked, and mortgage rates jumped. People blamed everything except the real culprit, basic supply and demand screaming for attention. While that was happening, Treasury yields were also rising. Investors could suddenly earn about 4.5% on 10-year government bonds with almost zero risk. To tempt them into MBS, yields had to rise even more, pushing mortgage rates towards 6 and 7%. Higher Treasury issuance to fund record deficits promises to keep that upward pressure alive. Now add another shaking floorboard, the weakening dollar. Washington says a softer currency will boost exports, but it also punishes foreign investors who see their dollar returns shrink when converted back home. Over the last 6 months, the dollar has lost roughly 13% against major currencies. That stealth tax makes overseas buyers far less eager to touch US housing debt. Less demand means yet higher mortgage rates. The gears keep grinding. Feel the tension yet? Good, because the chain reaction is just beginning, and it's about to get worse and worse. Higher rates freeze buyers. Sellers cling to yesterday's lofty prices. Listings stagnate. Builders halt projects. Local budgets strain as transaction taxes dry up. Existing owners who locked tiny rates during the pandemic become prisoners in their own homes, unable to move because new loans would cost double. A market built on easy refinancing turns brittle. Even if the Fed slashes short-term rates tomorrow, those deeper gears will not reverse. The central bank cannot force foreign investors to love a falling dollar. It cannot erase trillion-dollar deficits overnight. It cannot make pension funds forget the burn of 2008. The long end of the market now has a mind of its own, and that mind is nervous. Yet most news outlets whisper that everything is fine. They point to a few bidding wars and repeat the mantra that real estate only goes up. Meanwhile, the price-to-income ratio in many cities is already 7-1, more than double historic norms. If nothing changes, a typical family may need 10 or 12 times its income within a decade. That is not sustainable. It is a cliff. Picture the next stage. The Fed keeps dumping MBS, but buyers stay away. Prices of those bonds fall and yields leap, driving mortgage rates into the 8, 9, or even double-digit range. Each extra percentage point slashes purchasing power by tens of thousands of dollars. Desperate sellers finally cut prices, dragging appraisals lower. Builders fold, contractors lose jobs, retailers near stalled subdivisions shutter. The stress jumps to local banks whose collateral is shrinking. Municipal bonds wobble. To see how deadly that currency shift can be, picture a pension manager in Frankfurt. Last year she bought a bundle of American mortgages that paid 3% in dollars. Back then €1 bought $1, so her 3% coupon felt solid. Months later the dollar drifts lower. Now €1 buys $1.20. Her coupon still says 3%, but by the time she converts those dollars, her real return is barely above 1%. All the risk of a 30-year loan for the payoff of a savings account? No thanks. She reports to her board and they grimace. Next quarter, they will cut exposure. Multiply that decision by thousands of funds from Tokyo to Toronto, and you can guess what happens to demand. It evaporates quietly, the way water seeps out of a cracked pipe. Slow at first, then suddenly the tank is empty. The same pattern struck the market in the early 1980s, when double-digit mortgage rates slammed owners and values cratered in many regions for years. History is rhyming, but the stakes are larger now because overall debt levels are far higher, and technology spreads fear in seconds. A single viral headline can freeze buyers nationwide before breakfast. At street level, the effects will feel strange. For sale signs will linger month after month. Open houses will attract curious neighbours, but no bids. Eventually realtors will whisper phrases we have not heard in decades: seller subsidies, rate buy-downs, assumable loans. Investors will circle, but only with cash offers far below peak prices. The ordinary family who bought at the top will watch online estimates fall every week, powerless to stop the slide. Remember, markets do not move in a smooth line. They crack, then they cascade. The moment confidence dies, discounts turn into free falls. Those who prepared with liquidity can step in and buy assets at generational lows. Those who slept through the warnings will stare at statements they cannot bear to open. Right now, understand that the window to act is narrowing. Every month locks in higher rates and weaker demand. Shadow inventory, homes owners would sell if they could, grows silently. When that inventory finally hits, prices can gap down overnight. Analysts will appear on television claiming nobody saw it coming. You, however, are hearing the alarm in real time. Here comes the promise I made. The playbook is simple enough for anyone, and it has 6 steps, which the 6th is the best one that will do 50% of the work. First step, build a cash cushion equal to at least 6 months of living expenses in an account that never loses value. Liquidity is oxygen. Without it, you cannot breathe when the market seizes. Second step, eliminate or fix any adjustable rate debt now. Do not hope rates will drop. Protect yourself in case they rise further. Third step, if you plan to buy property, be patient and gather pre-approved financing. The first wave of forced sellers will be the richest hunting ground. Fourth step, balance your portfolio with high-quality dividend stocks and short-term treasury bills so that falling home values do not drag down your entire net worth. Fifth step, keep learning. Ignorance is the most expensive mortgage of all. And finally, the 6th step, which ties in with the 5th, is learning the best business to start during a housing crash. Thank you for staying to the end. Together we stared into the storm and found a path through it. Share this video with someone you care about because the clock is ticking and few people hear it. Subscribe and leave a like to help me making more and more content, and I'll see you in the next video. Just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depend on your own decisions and actions.